Treasuries are lower after today's $35 billion auction of 5-year notes. Now, it's a sign that investors perhaps are concerned that Washington won't reach a debt agreement in time. Well, from where we're going to turn now to Ian Lyngen. He's a senior government bond strategist at CRT Capital. He's joining us now from Stamford, Connecticut, live. And Ian, you know, we were just talking during the break. When you look at the U.S. Treasury curve, right, starting at 1 month, going all the way out to 30 years, there's a lot of different movement going on there, and for different reasons. So I was hoping you could give us a little bit of Treasury Trading 101 and look at the curve right now and tell us what it's responding to. So I was mentioning 4-week or the 1-month T-bill earlier. Those yields have moved up quite a bit over the last, say, 2 weeks. They were in negative territory earlier this month.
That they have. There's been a lot of, obviously, uncertainty associated with what is going on in Washington, the potential for a default. But for context, the front end of the market has typically tended to trade off of liquidity, the amount of currency and money there is put to work in the front end of the market. But if you go further out the curve, you look, say, for example, at the 2-year, that tends to trade even closer than the rest of the coupon benchmarks to the pace of monetary policy. So with the Fed's effectively zero interest rate policy on hold for the foreseeable future, we're seeing that section of the curve in a relatively tight range, call it around between 35, 55 basis points. The further out you move on the curve, say to the belly, to the 5, 7, 10-year sector, we're tending to see broader economic bets placed and or covered in those sectors, depending on where the data comes in, and over the last couple months at least, the prospects for a debt ceiling issue and or potential downgrade. Moving even further out to the long bond, the 30-year sector, that a lot of those movements tend to be based on inflation expectations and or a view for the longer-term prospects of the U.S. economy.
Right.
That's generally how we look at it.
So, Ian, in the context of what you've just said, when we talk about what's happening in D.C., a lot of people have marveled at the fact that the 10-year Treasury has not really moved that much. In fact, for the first time, I'm actually seeing prints above 3% on the 10-year. Why haven't we seen much movement there? Is it that everything U.S. ratings companies have to say is completely irrelevant at this point to Treasury traders? Is it in some weird ironic twist, a flight to quality into Treasuries? Or are there bigger reasons for why we're not seeing Treasury yields move very much?
Well, I think that we're dealing with the dueling forces of a slower U.S. economy, a weaker job market, high unemployment, which for most people, most economists and strategists expected that we would be in a better economic position than we are currently. But there's also this looming issue of, do we get a downgrade? And a downgrade and or default for the U.S. does have funding considerations and implications where there might be some broader liquidity issues that could hurt the U.S. recovery and the pace of the recovery. And at the same time, the rating agencies during the 2008 and 2009 period were really dealing with a crisis of credibility. And now, during the sovereign debt crisis around the world, they appear to be more dealing with an issue of relevance.
They seem to be trying to be a little bit more proactive and get ahead of where things are trading. But let me ask you this. What's worse, putting sort of the moral issues aside of defaulting on obligations, what's worse, default or downgrade?
Well, I think in this situation, a default will be viewed as temporary and selective, and the ramifications will surely be short-lived. The longer-term implications of an actual downgrade might have more relevance. If you looked at what happened to the Japanese economy, for example, in 2001 and 2002, when they went through their series of downgrades from AAA, that actually ended up being a bond bullish event, and it pushed there, or it was consistent with lower yields in that region as well. And that's going to be more of a function of the longer-term economic outlook.
So, Ian, very quickly, let's say there is a downgrade, and it seems that at least there's a 50-50 chance of that happening coming from S&P. What happens in the Treasury market? Do you expect to see 10-year yields, shoot up to 4%?
I don't think that we'll have a massive sell-off. I think a fair amount of the price action has already built in. We'll surely get a knee-jerk sell-off. Maybe we get 10-year yields to 320, maybe 315 range. But we'll find strong sponsorship as we continue to from both overseas and domestic investors, as we've seen at the auctions lately. And we expect that will ultimately prove a near-term buying opportunity.
All right, Ian, we got to leave it there. Thanks so much for breaking it all down for us. That was Ian Lyngen, Senior Government Bond Strategist at CRT Capital.